Okay, important key point to remember. Markets tend to revert to the mean over time. Here's a Case-Shiller index, everybody. You see this mean down here? This goes back to 1980. Robert Shiller's one of the 10 or 15 people in the world that I'll listen to. He's got a brain. He's good. Very good. He wrote the book Irrational Exuberance. He's good. I think it's going to revert down here. That's not even including an overshoot, folks. See this little blip up right here? Second key point to remember. Bear markets have 3 stages. Sharp down, boom, reflexive rebound, boom, drawn out fundamental downtrend. Whoops. It's going to come down here, then it's going to go flat. Just like it went flat here, just like it went flat there. That's what I see. That's what history's telling us. That's history talking to us, folks. How bad's this recession going to get? We don't know. All we've got is the latest data. I mean, it could return. There's a lot of people, I think, that are really smart. They're talking about some extreme numbers. If the whole debt thing collapses, we could revert to 1950 prices. If these banksters just pull the plug and say, we're not supporting anything anymore. Boys, go to cash, right? Get out of all this crap. Short the market. We're all going to short the market, and we're going to go to cash and let it collapse. Who knows how low it can go? We're equilibrium. Because if the economy gets real bad, this is based on today's income levels, what I'm talking about. Income could get hit really hard. So, you know, we have to watch this. We're monitoring this all the time. But I think we're at least going to 2000 levels. We got another 20% nationally to go down. Yes, Ruth?
So is that like at least maybe another 20%?
Yeah, 18 to 20 to get back down here. I talked about that, I think, in 2 newsletters ago. Yes, sir?
When will it level off?
When? Well, I think it's going to go down. I think, you know what? If I had to just take a guess based on a lot of information that's come into me before it starts going back up again, I'm thinking like 2015, 2016.
Wow.
Maybe more.
The last downturn was a solid.
I'm just going to pass the. I'm going to turn this into a Jim Jones Kool-Aid event. Let's just all drink up. I was like, oh, remember when those guys took off on the spaceship ride out of Rancho Santa Fe? Maybe we'll do that. Let's all go out so they'll remember us for a while. Okay. Yes.
You made a comment about the walking away.
So walking away.
If you currently have money in the bank now, the banks can go after that?
If you have a positive net worth, technically they can come after you. Like if you're Michael Dell and you're worth well, okay, let's just make that assumption. Okay, you're worth $5 billion and you walk away from your $20 million home on the Big Island in Kona, and he's got a big home in Kona, and you have a $15 million mortgage against it. Do I think that they're just going to let Michael Dell walk away from that home? No.
They can't go after California.
The retirement account?
I believe they can't go after that, but they can.
Well, he's got a lot more than retirement account.
I'm just saying, though, she was asking.
Oh, you're talking about your retirement account?
No. I don't think they can go after your retirement.
You know what? Look. I'm not going to comment on what they can go after because I'm not qualified to do that. Just be real careful, and hire competent people that advise you. Just don't do this on your own. If you're going to do something strategic like that, hire somebody so you do it correctly. You know, the time to get good information is before you take the action. Does everybody? Let me give you a little word of wisdom from somebody that's been through that before. Like if you're going to buy a fixer or something like that, you know the time to figure out what the thing's going to sell for is before you put the money up, not afterwards. Go, holy crap! I thought that thing was going to sell for 200, not 170. Well, there goes the profit. I mean, that's what people do. People make decisions, then they do their homework. Do it just the other way around. Okay, Case-Shiller 20 City Price Index, Home Price Index. This is seasonally adjusted. I don't use seasonally. I use non-seasonally. But here's that little blip upward again. You know, this is the recovery, folks. New home prices versus household income. This is from Ned Davis Research again. Good group. Look at this. Here's the old mean back down here. We still have this distance to fall. This is for new home prices. I'm going to start going through this kind of fast now. New home prices at 7-year low. This is our recovery, folks. New home prices are at 7-year lows, and there's been no rebound. Here's a supply of new homes on the market. We're at almost 14 months supply, new homes. And we need new homes production to what? That's the engine of the recovery. That's what's going to drive this economy. No, it's not there. New home prices versus rents. There's still room to fall. Here's the mean. You go back and look at it. Remember I said prices tend to revert to the mean? They do tend to revert to the mean. Because what's the mean? Normal. They go from abnormally high, revert back to the mean. Sometimes they get abnormally low, then revert back to the mean. They go both ways. Because what drives the market? Greed and fear. But are those statistically measurable? No. But that's what drives it. People get greedy at the top and take prices too high. They get too fearful at the bottom, take prices too low.